January 7th, 2026. The CME Group raised silver margins by 47%. Paper prices crashed 15% in a week. New York traders screamed silver collapse. Meanwhile, in Shanghai, physical premiums jumped to $8 per ounce above COMEX. Dubai dealers still couldn't source metal below $130. Tokyo buyers offering 60% premiums on secondary markets. Two prices, same metal, different realities. This isn't a market correction. This is the day the global silver market split in two. The first week of January 2026, silver had been climbing steadily from $72 at the start of the year, pushing toward $84 by midweek. Industrial buyers were scrambling, retail investors piling in, and the momentum looked unstoppable. Then, on January 7th, the CME Group made an announcement. Silver maintenance margins would increase to $30,500, a 47% hike, effective immediately, described in the official statement as a standard response to volatility. But anyone who's traded futures knows what this really means. A margin hike isn't about managing risk, it's about forcing liquidation. Every trader holding leveraged long positions suddenly needed to post 47% more collateral. Not tomorrow, not next week, immediately. Those who couldn't come up with the cash were forced to sell. And when thousands of contracts hit the market at once, prices collapse. Within days, silver fell from $84 to below $72, a 15% drop. Headlines across financial media screamed the same narrative. Silver crash, rally over, investors fleeing. On the surface, it looked like a classic speculative bubble bursting. Retail traders caught offsides, leveraged positions unwinding, momentum broken. But if you were watching the physical markets, you saw something completely different. The Shanghai Gold Exchange, where physical silver changes hands, showed premiums climbing, not falling, climbing. By late December, Shanghai premiums were running around $5 per ounce above COMEX spot prices. High by historical standards, but not unprecedented. Then, as New York paper prices crashed 15%, Shanghai premiums jumped to $8 per ounce. That's a 12% to 13% premium over Western benchmarks. In Dubai, physical dealers were still quoting prices above $100 per ounce when they could find inventory at all. Tokyo's Mercari platform, a secondary market for precious metals, showed individual sellers demanding 60% premiums. Two markets, same asset, completely different price signals. This divergence reveals something fundamental about how silver pricing actually works. For decades, the narrative has been simple. COMEX sets the global benchmark. London validates it. Physical markets around the world trade at slight premiums or discounts based on local supply and demand. But that system only functions when participants believe the paper price reflects physical reality. When Shanghai consistently trades 12% above New York, when Dubai dealers can't source metal anywhere near COMEX prices, when Tokyo buyers pay 60% premiums on secondary markets, the message is clear. The paper price is fake, and the physical markets are beginning to ignore it. While New York was celebrating what it called a successful deleveraging of speculative positions, Eastern markets were operating in a completely different reality. China's silver export restrictions, implemented January 1st, had fundamentally altered global supply chains. Only 44 companies received authorization to export refined silver. Those companies now controlled approximately 70% of globally traded physical supply. The restrictions weren't just bureaucratic hurdles. They represented a strategic decision by Beijing to treat silver as a critical national resource, alongside rare earths and other materials essential to advanced manufacturing. And the effect was immediate. Industrial buyers in Japan, South Korea, India, who had historically relied on Chinese exports, suddenly found themselves competing for dramatically reduced supply. The mechanism of competition, price, foreign suppliers were offered $8 premiums per ounce just to secure allocation from Chinese refiners. Indian buyers, historically price sensitive, were offering $5 premiums. And even at those elevated levels, many couldn't secure the tonnage they needed. This created a cascading effect throughout Asian physical markets. Bullion dealers in Dubai, a major hub for precious metals trade between East and West, found their traditional supply channels disrupted. European refiners, who would normally ship to Middle Eastern markets, were redirecting inventory to satisfy domestic and North American demand. The result? On January 1st, while COMEX futures showed $72 per ounce, physical dealers in Dubai and Tokyo were quoting prices as high as $130, an 80% premium over spot. This wasn't a brief dislocation that corrected within hours or days. These elevated premiums persisted throughout January. Even as New York paper prices crashed from $84 to $72, physical markets in Asia maintained valuations 50% to 80% higher. The bifurcation became impossible to ignore. Industrial users, the semiconductor manufacturers, solar panel producers, and electronics companies that consume approximately 60% of global silver production faced a critical choice. They could wait for COMEX prices to stabilize, hoping that the paper market's $72 valuation would eventually be reflected in physical availability. Or they could pay the premiums demanded by actual suppliers, securing the metal they needed for production, but at costs far exceeding their budgeted materials expenses. Most chose to pay, because unlike financial traders who can close positions and move to other assets, industrial users can't simply stop production because silver is expensive. The electronics still need to be manufactured. The solar panels still need to be assembled. The defense systems still need to be delivered. This steady industrial demand, combined with investor buying, created what analysts call backwardation in the futures market. Near-term contracts, trading at premiums to longer-dated ones. A clear signal that immediate physical delivery commands a higher price than promises of future delivery. And lease rates, the cost to borrow physical silver for short-term needs, exploded to 8% annualized. Under normal market conditions, lease rates sit around 0.3% to 0.5%. An 8% rate means the market is desperately short of available metal. Someone needs silver so badly they're willing to pay 16 times the normal borrowing cost. These aren't the characteristics of a collapsing market. These are the characteristics of acute physical shortage, masked by paper price suppression. In Eastern markets, operating closer to physical reality, we're pricing silver accordingly. The margin hike wasn't random, and it wasn't the first time exchanges have used this tool when silver rallies threatened to escape control. In 1980, when the Hunt brothers pushed silver toward $50, exchanges raised margins repeatedly until leveraged positions collapsed. In 2011, when silver again approached $50, the CME implemented 5 margin increases in 9 days. The rally broke. Prices fell from $48.70 back to the low 30s. And now, in January 2026, as silver pushed from $72 toward $84, the same playbook. The stated rationale is always the same. Managing risk, protecting market integrity, responding to volatility, but the actual effect is forced liquidation. Here's how it works. When you trade futures with leverage, you're required to maintain a minimum amount of capital in your account relative to your position size. This is called maintenance margin. If the exchange suddenly increases that requirement by 47%, every leverage trader faces an immediate choice: post more capital or close positions. Most retail traders don't have extra capital sitting idle. They're using leverage precisely because they don't have the full amount to trade without it. So when margins spike, they're forced to sell. And when thousands of contracts hit the sell side simultaneously, our prices collapse. This serves 2 purposes. First, it removes speculative excess from the market. The traders who were long with heavy leverage get flushed out. The rally momentum breaks. Price volatility decreases, at least temporarily. Second, and this is where it gets interesting, it creates a window for deeply short institutional players to cover positions at suppressed prices. If you're a bullion bank that's been short silver for years, betting that prices would stay contained, and suddenly silver rallies 147% in 12 months, you have a problem. You need to cover those shorts. But if you try to buy back contracts while retail momentum is pushing prices higher, you'll drive the market against yourself. Your covering becomes fuel for the rally. But if the exchange raises margins, forcing liquidation, prices drop sharply. And in that chaos, you can cover short positions at much more favorable levels. The evidence suggests this is exactly what happened in early January. CME delivery reports showed JPMorgan and Citibank taking aggressive physical delivery. In just the first week of January, 33.45 million ounces were withdrawn from COMEX registered inventories. That's 26% of available supply, gone in 7 days. These aren't the actions of institutions bearish on silver. These are the actions of major banks converting paper positions to physical metal, while prices are temporarily suppressed. The cost? 44 silver trading firms in Rajkot, India, declared bankruptcy. Combined liabilities close to $425 million. These were established businesses that held paper positions. Betting on higher prices, crushed when the margin changes, forced liquidation. Meanwhile, Citigroup published research stating silver looks fundamentally overvalued above $70. They project an average price of $70 for 2026. This is the same bank that missed a 147% rally in 2025. The disconnect between institutional messaging and institutional actions couldn't be more clear. What happened in January 2026 wasn't just a price correction. It was the beginning of a structural split in how silver is valued globally. For decades, the assumption has been that COMEX and LBMA set the global benchmark. Physical markets might trade at slight premiums or discounts, but fundamentally, everyone agreed on what silver was worth. That consensus is breaking down. The Shanghai Gold Exchange, where actual physical delivery happens, is now consistently pricing silver 12% to 13% above Western paper benchmarks. This isn't a temporary dislocation. It's a persistent premium that reflects fundamentally different supply-demand dynamics. And the implications are profound. When physical markets decouple from paper markets, price discovery shifts. The question is no longer, what can you sell a futures contract for on COMEX? The question becomes, what will an actual industrial user pay for metal they can touch, metal they can put into production, metal they know exists? The same transition happened with lithium. For years, lithium was traded as a commodity with paper contracts setting the benchmark. Then electric vehicle production exploded. Industrial demand overwhelmed available supply. And suddenly, the only price that mattered was what battery manufacturers would pay for actual delivery. Paper markets lost relevance. Physical supply chains became the benchmark. Silver is following the same path. 6 consecutive years of structural deficits. Industrial demand consuming 60% of production. Solar energy installations accelerating. Electric vehicle production scaling. AI data centers requiring massive amounts of electronics. 5G infrastructure buildouts continuing worldwide. These aren't discretionary uses that fade when prices rise. These are strategic industries receiving government support, policy mandates, massive capital investment. And the supply side, mine production essentially flat. Above ground inventories falling, COMEX registered stocks down 70% since 2020. London Vault's experiencing periodic squeezes. The 2024 deficit alone was 148.9 million ounces over 4 years. Cumulative shortfall totals 678 million ounces. That's not getting made up. You can't print physical silver. In this environment, the paper to physical ratio becomes critical. Currently sitting at 356 to 1. That means for every ounce of physical silver, there are 356 ounces worth of paper claims. This system only works if most participants are satisfied with paper promises. But when industrial users start demanding physical delivery, when Eastern markets consistently pay premiums for actual metal, when lease rates hit 8% because borrowed silver is scarce, the leverage unwinds. Professional analysts are beginning to acknowledge this reality. The LBMA 2026 forecast survey, gathered from institutional analysts and traders, projects silver averaging $79.50 for the year. That's a 98.8% increase from their 2025 forecast. Individual forecasts range from $42 to $165. With silver already at $95, 9 of the 26 forecasts have been breached. Most mainstream analysts now consider $100 per ounce not speculation, but an inevitable consequence of structural supply-demand imbalance. But the more significant development is the shift in where price discovery happens. If Shanghai maintains 12% to 13% premiums, if Dubai dealers continue quoting triple-digit prices, if Tokyo buyers keep offering 60% premiums on secondary markets, then the physical market is asserting price leadership. COMEX can suppress paper prices with margin hikes, but they can't create physical silver, and they can't force Asian industrial users to accept Western paper valuations when actual metal commands much higher prices. This is how benchmark transitions happen, not through official announcements or regulatory changes, but through the quiet accumulation of market participants choosing physical reality over paper promises. The ultimate risk for paper holders? Cash settlement? If COMEX can't deliver physical metal to contract holders, if exchanges are forced to settle in dollars rather than actual silver, that becomes the moment the system breaks. Because once markets realize the casino has no chips, the paper price becomes irrelevant, and physical supply chains, operating at premiums that reflect actual scarcity, become the only benchmark that matters.